The most depressing thing about your mortgage is this thing called a table loan. Well, it's not the most depressing thing, it's just a surprise. So a table loan describes the way that your mortgage is set up, and it basically means that every time you make a repayment, part of it is going to go to the loan, the money that you borrowed, known as the principal, and part of it is going to go to interest. So your first repayment, let's say it's $1,000 a week, you would hope that that $1,000 reduces your mortgage by $1,000. But it doesn't, because most of it goes to interest and only a small bit will go to principal. So if you have a $500,000 mortgage, you pay the first $1,000, you're thinking, sweet, my mortgage is going to go down to $499,000, where it's probably only going to go down by like $100, and $900 is going to go towards interest. But the good thing is that every single time you make a payment, more of it, so a higher percentage, will go to principal and a lower percentage will go to interest until you get about halfway when they're equal, and then more of that payment will go to principal and less will go to interest, and your loan balance will actually decrease or look like it's decreasing a lot faster than it did at the beginning of the mortgage. And understanding this principle is really important, because then when you make extra repayments, which of course is going to be in another video, your extra repayment goes solely to the principal. It doesn't go to the interest. So you're actually reducing how much your interest is charged against. And I'll show some examples in the future of how much difference that makes when it compounds. Like something like $200 per week can save like 10 years on your mortgage because of the compounding effect. Now, the opposite of table loans is an interest-only loan. And all you're doing with this payment is you're just paying the interest charged by the bank. You're not actually decreasing the principal. Some investors like this option because it just means that their cash flow is a bit higher, because if you're just paying interest, the repayment is lower. But of course, if you're holding this property for long term, for example, it's your home, then you probably want that to be mortgage free at some point. So going interest only is not really a good idea, and nor will the bank usually approve that, because they actually want you to decrease their lending and the debt that you owe them so that you eventually have a mortgage-free property.